Here's what happened in the stock market today. The stocks were actually up early. Then we got a comment from one of the Federal Reserve presidents out of Minnesota, and that sent stocks downward about 2%. Basically, the comment was inflation is sticky. And because of that, he wasn't certain that there would be any interest rate cuts throughout this year. Now, this is echoing a lot of the things that I've been saying, that I don't see inflation coming down, hitting the 2% target rate that the Federal Reserve is hoping for, and then lowering interest rates. But I don't want to really talk about inflation right now. Tomorrow morning, of course, we get non-farm payrolls, and this could be the real issue. The Federal Reserve is going to have to keep interest rates a little higher, a little longer. What will happen next is the rate of growth for the economy, for everything involved in the economy, is going to slow down. Because of that, the stock market might take a hit in a big way. Let's jump in. I want to show a couple charts as to what I'm looking at and explain what I think might be happening. And it's really the big picture that you're looking for, and it's showing up in the stock market today. Let's jump in. Here's a look at the S&P 500, and as you can see, we were doing just fine this morning. I had some trades on, made a little bit of money, took it off the table, went to the gym to work out, and then started getting alarms all over my phone. And this is what happened. The comment, consistent with a lot of the things I've been saying, inflation is stickier than the stock market is wanting to believe, and I don't see 3 rate cuts this year at all. And for the Minnesota Federal Reserve President Neil Kashkari, for him to have made that comment is consistent with what I've been saying for a long time, that we're not going to hit that 2% target rate. And because of that, interest rates are not going to be lowered, and we're going to see a lot of the pain from this starting in fall. I don't think this is the beginning of the end of the rally in the stock market. But it really boils down to the rate of growth. In the meantime, here's a quick look at the S&P 500 again. This is the 4-hour bar chart. And as you can see, since early January, we've been just going higher and higher and higher. Have we peaked? Maybe. Probably. We're going to find out some more information tomorrow morning, and that's going to be really crucial. But it's the rate of growth. Non-farm payrolls come out Friday morning, and I'm anticipating the lower end of this underneath the 200 increase for non-farm payrolls. So what's going on here? It's all boiling down to rate of growth. So where I start my analysis, I look at the rate of growth of incomes, because this is the real driver of the economy. You don't really get much in the way of rate of growth when it comes to government expenditures, because they're pretty flatline. Sure, there's increases throughout the year, but it's a continual gradual increase. However, employment and personal incomes really is the starting driving point for the economy. If the rate of growth of personal incomes is increasing, so will expenditures. Those expenditures turn into revenues for companies. Companies may have to hire more and more people. What we're seeing, and if you look at this chart right here, non-farm payrolls, we're seeing a declining rate of growth of new jobs from non-farm payrolls. I don't expect personal incomes to move much higher. I expect we're probably going to be stuck in this range right now with personal incomes and expenditures, and because of that, companies are probably not going to be hiring more and more individuals. We're at 3.7% unemployment rate. There's not much more room to pack more people in there. So the growth rate for the economy overall is going to start to shrink. That shrink is what's really driving or will drive the future of the stock market. The stock market has been chasing yield in anticipation that interest rates are going to move lower. Inflation is not going to allow the Federal Reserve to lower interest rates at the pace that everybody's hoping for. And because of that, we're going to see the rate of growth of GDP. And let me pull this up real quick. This is GDP growth rate. We had about a 3.1% GDP growth rate year over year in the last print, and I expect that'll probably moderate, probably closer to 2%. 2.25, 2.5. We'll see where that prints. But if your profits for companies are going to be or are being priced in at a higher growth rate, and we see these year-over-year growth rates declining, so will the stock market. This interest rates being higher is going to be sort of the cause of this. We'll start to see the symptoms: lower non-farm payrolls, unemployment rates starting to inch a little bit higher and higher and higher, gradually, quietly, like the proverbial frog in the boiling water. And it won't be for a while until the market catches on and sits there and says, listen, that's it. Interest rates are not going to drop. The growth rates are going to drop. And the expense on that is, of course, growth for employment and personal incomes, which will push people to start selling their stocks. Those growth rates are just not going to be there. This is what I'm going to be focusing on throughout summer, going into fall. And if you have been following me for any period of time, I wrote back in October, November of last year, where I sat there and kind of spelled out the economy as I saw it. I figured that the stock market would push all through springtime higher, then stagnate throughout summer, but sell off and get real ugly September, October, November of this year. That scenario is playing out. We might have peaked with the Dow. The Dow just hit the 40,000. We'll see how the number comes in tomorrow morning. But it's really, when you look at non-farm payrolls tomorrow, start thinking about that one variable, growth rate. If we see a decline in employment, which is, of course, a lagging indicator, you can expect that that companies are seeing revenue growth rates that are declining. The stock market is already priced in higher growth rates. Stock market will sell off. It could get ugly starting tomorrow. May take a while. I'm still targeting that we see the decline in the fall of this year, simply because we could still see a solid number tomorrow, maybe 175 to 200. And if we get a number like that, that's just enough for the stock market to say, well, we're still growing. And so we won't get a sell-off from that. And because of that, that could perpetuate the stock market a little bit higher. We'll continue to get this data coming in. Payrolls, that's a lagging indicator. So it's going to be tough to gauge that off of tomorrow's number. But if we get an ugly number tomorrow, that could really spell out a panic for the stock market. Nonetheless, make sure to hit, if you're just finding my channel for the first time, make sure to hit that like and follow button. Also, there's a link down below. I'm officially moving my website to Substack. The link is down there below. Get the free email newsletter where I break down economic analysis like this and how it applies to the stock market. We'll see you in the next video.